So we'll start the ball rolling with that sort of question, and the idea would be to see what we feel were the catalysts that really started the subprime market. Anyone like to kick off?
We'll start with mortgages, and that's kind of your area, so I'll volunteer you for that one.
Currently structured finance, I think that's where
okay. So I've noticed the terminology started to change in the newspapers from global financial crisis through to starting to talk about recessions, and there's been sort of the idea of a depression kind of floated on a couple of occasions. One of the sort of original starting points for the global financial crisis that has been largely touted is the mortgage market in the United States. There's been a bunch of different parts of that, and there's different segments of it. We might break them up amongst us, but the mortgage market in the United States had a huge run in the last 8 to 10 years, meaning that the values had increased substantially off their, off their median or off their long-term base. If you have a look at an inflation-adjusted look at the snapshot of the growth in the mortgage market in the United States, the real growth has happened in the last 10 years. It has been a substantial run, and people are calling it a bubble. And for all intents and purposes, you can say it is a bubble. That bubble ended a couple of years ago. And when that happened, there was a huge amount of leverage in the system, and a lot of that leverage still exists. The mortgage market's a little bit different in the United States, and we can talk about the details of it. But defaults are more common, and when someone defaults in the United States on their mortgage or on their loan, the process by which the banks receive their money is a little bit different. Okay, so it's all about the obligations, or it's about the rights of the bank to go in and get their security and secure them. When I talk about mortgages in the United States, one of the key points is that the amount of leverage has steadily over the last 10 or 15 years been increasing. What I mean by leverage is debt against the asset. So a house is worth $500,000. There's a mortgage against that. In the past, you might have been able to borrow 60, 70, 80%. There's two parts to that. So the amount you can borrow against that particular house has been going up, so the leverage ratio has been going up, and also the credit quality, i.e. the ability of the people that take those loans out has been dropping. So those two factors have come together, and then the last factor is the market factor. The market's had a large run. That run's petered out, and the values are now going down. As the values go down, people aren't able to pay their mortgages anymore, and it's actually interest rates go up. So the interest rates in the United States started to rise. They've then got to the point where a lot of people can't pay their mortgages, and then they've defaulted, and it's easy to walk away. So in the United States, you can, not in all cases, but in many cases, you can literally put your keys in the letterbox and you can leave. So that's it, you don't have to pay anymore. And in Australia, it's much more stringent in that they will chase you relentlessly through various different avenues to make you pay back that particular loan. And I just want to talk briefly about the standards, and this might be your area a little bit more, but the standards of lending dropped substantially. So in order for, and it's a demand-driven thing as well, so structured debt, or the structuring up of those mortgages into securities. So in and of itself, a bank loan against a house is not something that you can rate. It's not a security. You can't sell that with any degree of certainty about whether that person will repay. But if you can put thousands of mortgages together into a structured vehicle, then you can normalise, or theoretically, you should be able to put on some sort of default graph. You should be able to work out roughly the amount of people that are going to default and at what rate and at what period of time. And that's probably Brad's area, probably much more specifically. But the point is, with that, you can turn thousands of mortgages into what's basically a security, which can be traded. Mortgage-backed security, collateralised debt obligation, asset-backed security, all names for big structures created out of lots of little assets. Mostly mortgages. Mortgages are the biggest one. There's a huge demand for that particular kind of mortgage. If you're a hedge fund or if you're a managed fund, you can't put the debt portion of your portfolio into the bank. You have to get that exposure through bonds. So, you've done portfolio management, I'm assuming. So if you have an optimal ratio of debt versus equity, the debt portion has to come through bonds. Those bonds, if there's not enough government bonds, which in Australia there isn't, because the government hasn't been borrowing as heavily, well, I'll say that was up until last year, there's not enough government bonds, they're made up enough corporate bonds, but there's a lot of money. So what people do is they'll buy securitized or structured products. To get those structured products, the advantages are they're plentiful, they were considered relatively safe, and the yield is slightly higher than bonds anyway for a commensurate credit rating. Now, as that process increases, there's a lot of money, there's not enough bonds. The demand for different kind of assets to be securitized becomes enormous. What they've done is they've gone into increasingly bad quality types of assets and then bundled them up, structured them up, investment banks have structured them up, and then sold them to investors. Now they've been rated, and that means that they get over a certain rating, which means that they can then become investment grade, which means that they meet the mandate for a large investment fund. Those investment funds, with an extra yield of say 1%, 100 basis points, that might be enough to take on an asset which is substantially more risky, given that they have a history of a good track record. So there's a demand element, and there's kind of a supply element as well. So people are demanding more. There's a culture in the United States and Australia as well of home ownership, and there's the other side of that, which is investors are interested in putting their money into something. They must employ that money. So that's kind of an overview of how it started, and I'll let these guys talk because I don't know where we don't have a lot of time, but if someone wants to take the next step, and then I don't mind talking a little bit more about
we have covered three of our topics in one, so that's fine.
We might have been earlier than if we covered that.
I was going to say, one of the other sorts of questions might be how such a small segment of the, you could say, American financial markets could end up having an impact across the globe generally. So we've got a global financial crisis from what was a relatively small segment of the mortgage market in the USA going wrong. So this is a question of contagion and how it could in fact infect the whole world. Anyone like to have a go at that one? We've actually had a little bit of a lecture on this beforehand, so the students have a background on it. But it is just a question of how to do that. And I suppose the key element here is how, in fact, the flawed assets underpinning those mortgages, the flawed mortgages, were sold internationally.
I'm happy to address that. I mean, sometimes just to leverage off what Len was sharing with you. Let me start with a little bit of context, because I think it's really important we understand the context of the global economy and some of the trends that have been happening that led to this event, and how come there is a level of interconnectedness between the different economies.